Hello everyone and welcome to Financial Accounting with Anne-Marie Anderson. Today we will be learning to calculate depreciation using the units of production method. If you're still unclear on what depreciation even is, I'd suggest you watch the depreciation overview video first. Okay, let's get into it. The units of production depreciation method allocates the cost of an asset based on its actual usage or output rather than time, matching expense with production activity. Let's revisit Manny, who just bought a delivery van for his business. It cost $46,000. He estimates that he will be able to drive the van for 80,000 miles before disposing of it. He anticipates that he will be able to sell the van for $6,000 at the end of those 5 years. This is the residual value. The journal entry is a debit to delivery van and a credit to cash for $46,000. Our ledger account, or T account, would have an asset of $46,000 recorded, which is called the book value. Since we just purchased it, there wouldn't be any accumulated depreciation just yet. Units of production requires a two-step process before we can calculate annual depreciation. The first step, let's calculate a rate per unit. Here's the formula. Take the cost of the asset, subtract its residual value, that's the amount you expect to recover at the end of its life, and divide the result by the total estimated units. In this case, we're using miles. Well, that makes it 46,000 minus 6,000 in the numerator. And remember how I said that Manny expects to use the van for 80,000 miles? Well, that 80,000 miles is the denominator, which gives us a rate of 50 cents per mile driven. That means for every mile the van is driven, we are depreciating 50 cents. On to step 2. Now that we have the rate, we apply it each year to calculate that year's depreciation expense. At the end of year 1, the van has been driven for 30,000 miles. 30,000 miles at 50 cents per mile is $15,000 of depreciation in the first year. The journal entry for depreciation is always the same, with a debit to depreciation expense and a credit to accumulated depreciation. But for year 1, we have just calculated the amount to be $15,000. This may be easier to visualize in T accounts. You still have the value of the van at $46,000, which is untouched per the cost principle. The accumulated depreciation van account now has a $15,000 credit balance, so when we net the two accounts together, the current book value of the asset is $31,000 after the first year. Manny continues to use the van to deliver his merchandise, and each year we calculate depreciation based on the miles driven. Year 2 is 25,000 miles, year 3, 13,000, year 4, 7,000, and year 5, 5,000 miles. At 50 cents per mile, that makes depreciation $12,500, $6,500, $3,500, and $2,500. Once we put it into T accounts, you can see how the accumulated depreciation account increases by different amounts each year, which are determined by how much the asset is used from year to year. We do this until the asset reaches the residual value. At 80,000 miles, Manny decides to sell the van to Alex for $6,000, and the van is removed from Manny's books. In all depreciation methods, assets are not depreciated beyond residual value. Now, residual value can be zero if we don't think anyone will want it at the end of its useful life. We would just use zero in our initial calculations. The units of production method does accurately match depreciation expense with actual asset usage and revenue generation. The more miles driven, the more depreciation. The less miles driven, the less depreciation. That makes sense, right? But on the con side, this is time consuming, and it can be difficult to apply when the usage data is hard to measure. Miles are easy, you can check an odometer, but other measurements may be harder to obtain. For example, other common units that might be used are machine hours for manufacturing equipment, units produced for production machinery, miles driven for vehicles, hours used for tools or heavy equipment, or whatever makes sense for your business. Well, this wraps up units of production depreciation. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.